we're in the early stages of a bubble. There's more uncertainty coming into the economy, a little more leverage, in some cases, a lot more leverage. So long as the price is going up and people think I got to get on this wave, you're going to see this continue. The famous phrase, it will continue until it stops, and then it'll be a really nasty exit. The stablecoin industry will ask for permission to have other types of assets back the stablecoin. That's when you begin to see the creeping into a higher risk instrument called a stablecoin. And then you have a moment where people lose confidence, and then you have a run, and they'll turn to the Fed for bailouts.
I'm very pleased to welcome back to the show Thomas Hoenig. He is the Distinguished Senior Fellow at the Mercatus Center. He was previously president of the Kansas City Fed and vice chair of the FDIC. And it's always an honor to have Dr. Hoenig back on the show. We'll be discussing the state of the economy, what's next for the Fed, and the emergence of digitization of the dollar known as stablecoins. We'll talk about that. Welcome back to the show. Thomas, good to see you again.
Good to be back. Thanks for having me.
I want to start by giving a timely update on the economy. Let's start with the Fed. We're speaking one day ahead of the FOMC decision, and by the time this airs, the FOMC decision will probably be just taking place. So what is your expectation for not just this particular meeting, but for the next few meetings, Thomas? What is the guidance from the Fed that investors should be paying attention to this Wednesday?
Well, I think number one, the Fed will ease tomorrow. That's a pretty clear outcome, already been signaled. And I think it's probably more than necessary, given the way things are right now. They're very strong in the economy, and yet the Fed's going to ease. Inflation actually went up a little bit up with this last report. That's 3%, been at 3%, well above their target. So I think the chairman Powell will be very cautious in his press conference. He will acknowledge the importance of the cut. He will emphasize the employment numbers as being where they're focused, and they're, in a sense, allowing inflation to run a little bit high, or a lot high actually, because of the employment concern. And then he'll kind of back off after that. He won't want to signal too strongly for another cut at the next meeting, although the markets fully want him to, and fully are going to put a lot of pressure on him, as well as the administration and politicians to cut. So he'll have that to deal with, kind of work his way through on the conference. He'll get questions about it over and over again, and we'll see. Beyond that, it's impossible to know what the future holds, given that we still don't have all the data. We're lacking data. The Fed's lacking data, and so forth. So I think cut now on uncertainty going forward. But a lot of pressure on the Fed to cut rates again come December.
What is the likelihood that we'll have a new Fed chair by December? The betting market is actually factoring in a higher probability that we will not have a new Fed chair. But Scott Bessent, as you know, earlier this week, Treasury Secretary, has announced his top picks for a new Fed chair. So how does this process work? When can we expect one?
December seems perhaps a little bit early to me, but if they're through that, they'll go ahead. They can go ahead and make the announcement. It will start changing the dynamics in the marketplace. I think the president knows that, and so does Bessent. So I would agree that with the markets, maybe a little soon December, but I would say January, February, almost for certain, because it takes time to get the hearing set up and the confirmation going. So I'm thinking January, February will be the time for it.
How significant would a new Fed chair be for Fed policy? Some speculate, for example, Jerome Powell could still stay on as a governor. That's a possibility, not confirmed yet, of course. And I wonder how much weight a new Fed chair does have on the direction of the Fed funds rate.
Well, I think the new chairman will have a lot of impact, as they all do. He leads that group, and he will apply the bully pulpit of the chair to get the policy in the direction he thinks it should go. I don't know how well he'll listen, because I don't know who the candidate is. I mean, I don't know who the chairman is, but of the ones that were named, I know 4 of the 5 that probably listen, but they still will pick the policy, and people will tend to follow that policy. That's what I expect to have happen there. Will Powell stay on? I doubt it. I wouldn't if I were him. He's served his term, and to think that he could somehow block this new chairman by staying on the board, or block another nominee, which would be a dynamic change. I don't think he would pay the price to do that, because his life would be pretty difficult in doing that.
The 5 finalists named this week: Christopher Waller, Michelle Bowman, Kevin Hassett, Kevin Warsh, Rick Reeder. What was your reaction to seeing this list? Any surprises for you?
No, I don't know Reeder. The other 4, no surprise at all. They've been in the mix since the start of it almost. They're all qualified, and it'll be, I think, frankly, a big part of the choice will be who will do the president's bidding most likely, and I don't know who that is. If any of them, they may, as chairman, want to establish their own independence, but I don't know. But I would suspect he will be looking for someone who pretty much does as he would like them to do.
Well, of the 4 that you do know, independent of the president and his administration's policies and views, are they all dovish? And how are they? What is their approach? Do they have differing approaches to fighting inflation?
They have different attitudes towards it, I would say. Warsh is more hawkish at the moment. Hassett, I think he's playing it very neutral right now. Waller has been dovish, as you can tell, and Mickey Bowman has been kind of mixed, dovish to hawkish. She wants to shrink the balance sheet more, which is more of a hawkish move. At the same time, she did vote for cuts and did dissent when they didn't give the quarter-point cut in July. So she's in the middle, and I don't know Reeder. I don't know how he would.
Well, given that these picks are from the administration, is it fair to make the assumption that it doesn't really matter at this point where inflation goes? We can expect rate cuts either way.
Well, I don't know that for sure. I think if the economy slows and if unemployment rises, I think we can expect cuts. But if inflation were to start to increase too rapidly, I think people like Hassett and Warsh and maybe Waller would, and certainly Bowman might say, we need to stop cutting. We need to think about raising rates at some point. So I think it depends on how the economy goes, even for these individuals, because even the president knows if inflation gets out of hand, he will be blamed for it.
The 3% inflation headline CPI that you mentioned earlier, that was a dramatic rise from what we had earlier. The last time we had 3% was at the beginning of the year. Thomas, is this progression in line with your expectations? Is it moving too fast, or is it just about normal here?
Well, it's in line with my expectations because, number one, we did expect some inflationary pressure from the tariffs, and we've gotten that. It doesn't dominate, but it's added to the inflation number. That's number one. Two, we have an enormous, I think, spending spree going on in the investment side with AI. The consumer is now very busy in the sense of spending. They've been a big part of this strong economy that we've had, and the third quarter numbers should be close to 4%, I'm told. So I think that's really going to drive things going forward in terms of the FOMC and different policymakers' outlook for the economy.
Growth of the economy itself. We've just had reports that several big tech companies and other companies in other sectors are cutting their workforce today. So recent layoff announcements. Amazon announced a cut by 14,000, I think, today, but over the last month or so, up to 30,000 employees. UPS, 48,000, Intel, 24, Nestle, so on and so forth. A lot of these companies like Amazon are citing automation as one factor, making their company a little more leaner. I don't know if this is just an issue of companies trying to shrink their costs, which could be a good thing for corporate margins, or it could be a signal for a deteriorating labor market overall. What is your read on the current situation, Thomas?
I think it is somewhat unique right now to the tech industry. They're trying to come back so they can employ and spend more on AI, and I think that's a big part of their goal here, and that's why these cuts are taking place to kind of force that issue. On the other hand, healthcare, it's growing employment very strongly. Manufacturing's weak, and that's partly because of the tariffs. So you have this mixed bag, as you always do with the economy. But I think overall it's slowing, but modestly. I don't expect that unemployment right now, and we won't get the numbers on it, but I'm guesstimating that it'd be about 4.5% rather. And I think that's no surprise. It's in my expectations, and should not be a reason for the Fed to cut rates unless they think it's so embedded in the economy that we'll see larger job cuts later, and I don't think that's in the forecast at the moment.
What is the unemployment level that would worry the Fed? Is it the level of unemployment that would prompt a rate cut decision, or is it the delta, meaning the rate of change of unemployment, that would be more of a factor here?
Well, at this point, either one, because to get the unemployment rate up high enough for them to in a sense make a strong action in cutting rates, it would have to be a big delta, but it also means it would have to be above, it would have to be above 4.6% or even 4.7%. And so that's really, what they'll watch. And I don't think they expect that. And at the moment, I wouldn't expect that. We have, what's going on in the labor force is that, as Powell has indicated, yes, we're having a slowdown in demand, but we're also having a slowdown in immigration and the supply of labor. So these two are kind of balancing out. And overall, I think these job cuts from these tech companies, these people will be reemployed fairly rapidly. I think it's new entrants who will find the most difficult to find employment. If they're inexperienced, they don't have enough. These institutions like Amazon that are not hiring more, so they'll be slower to be hired than the more experienced layoff players.
Powell called this economy a slow hiring, slow firing economy. This just sounds like equilibrium, does it not, Thomas?
Well, yeah, it is. And under the circumstances, it is. I mean, you're not seeing a sharp drop off in labor demand. You're not seeing, in every industry layoffs or fear coming into the economy. So that's the demand side. The supply side, yeah, you've had a slowing down in immigration, a slowing down in terms of job seekers. So I think it's an equilibrium, an unusual equilibrium at a low pace.
I want to switch gears now and talk about the regional banks. You were former vice chair of the FDIC, so you know about banks better than anybody else I can think of. Thomas, the regional banks that plummeted on Thursday, this was a couple weeks ago, were Phoenix-based Western Alliance Bancorp, Zions Bancorp. Zions fell 13%, Western Alliance stock fell nearly 10%. Some bad loans were exposed on the news, and that's what prompted the pullbacks. The earnings their performance was so disappointed. Jamie Dimon of JP Morgan Chase warned that once you spot one cockroach, there's probably more lurking around in the corner. He's referring to banks with bad loans. We've had a regional banking crisis 2 years ago. This is nothing of that sort of happening now, but just interpreting the news that's coming out recently, what is happening here? Can you explain?
Well, I mean, the economy's been on what I call a blitz in terms of the level of lending. It was up pretty significantly in the first half of this year. You have a lot of loans being made, and then you're seeing some fraud. I mean, some of these were deliberate fraud. They were, duplicating their use of collateral to different lenders. These things happen, especially when the economy is in a more speculative mode, which it has been, and so you've had these kinds of events take place. But the banks that were involved, they have absorbed these losses. But the real issue that you don't know, and this is the Jamie Dimon comment, is this an indication of other firms that have got into speculative borrowing, speculative activities that are now coming home to roost? And will we see more announcements in the months and weeks ahead? So that's a risk, because I think part of what's going on here is we're in the early stages of a bubble. We have very strong investment in AI, a lot of activities around that. We've had subprime lending, that's coming back. We have the consumer kind of leveraging up their position so they can maintain their levels of consumption. So there's more uncertainty coming into the economy, a little more leverage, in some cases a lot more leverage for some of these companies. And therefore, that means these banks are more vulnerable. So as a result of what you've witnessed, these regional banks are going to be scrubbing their loans much more carefully. This is very much different than Silicon Valley, which was a market risk problem. This is a credit risk problem, which in some ways is more serious. So they're going to be very careful and looking very carefully at their portfolios over the next quarter or beyond.
The credit risk issue, how does that start? Can you just walk us through how banks even get themselves into credit risk issues? Presumably, we've had regulations that should prevent this. Do we not?
Well, regulations only go so far. And what you really have to be careful of is in a growth economy, an economy that's been stimulated with the Beat Inflation Act and so forth, where a lot of money is poured in. These are they're looking for margin, and they have these borrowers who are willing to pay it. Now they can put covenants in, but the competition usually puts pressure on these banks to ease off on their covenants, on their reporting covenants, on their collateral check covenants, and it becomes more risky just by the nature of easing off on the covenants, making loans to companies that have a little less of a strong balance sheet, a little more leverage than they've had, more borrowing. And those are the things that happen in the boom side of things, the boom side of the economy. And if we are, slowing, and that's what people don't know for sure, but if we are slowing, then those, as the tide recedes, then you see who's in the water naked. And that's really what they're fearing now. And I think many of these regionals are tightening up their lending standards very quickly right now and double checking their collateral very carefully. So there's a lot of double checking going on right now. And if they find more problems and they start announcing more problems, then the uncertainty and the fear, what I call the psychology of panic, begins to take over. We want to avoid that, but that is a risk.
Can we expect an easing of lending standards alongside an easing of monetary policy from the Federal Reserve? Is there a relationship there?
There usually is, as the Fed stimulates and creates a environment that's conducive to a growing economy, conducive to lending, lowers their interest rate, allows them then the banks to search for yield. Yes, there can be that effect. That's the intent of lowering interest rates and stimulating the economy on the part of the Fed.
Now let's talk about some new developments in the banking industry. I'm referring to the tokenization of money here. This is just one story, but it's a broader trend. So early in the summer, following the enactment of the Genius Act, the following banks, Goldman Sachs and BNY, are transforming a lot of their money market funds into tokenized assets here. So here we go. The clients of BNY, the world's largest custody bank, will be able to invest in money market funds whose ownership will be recorded on Goldman's blockchain platform. Project has already signed up fund titans, including BlackRock, Fidelity, Federated Hermes, as well as the asset management arms of Goldman and BNY. Thomas, going back to the credit risk that we talked about, this doesn't affect credit at all. It's another form of listing your assets, right?
Exactly. Well, there's a couple things here. One of them is, you tokenize your assets. It's encrypted. It's safe. That's merely converting your asset into a tokenized, encrypted electronic transaction. Stablecoins are you actually are issuing a liability, a token, and you're receiving dollars for it, and then you invest those dollars under the Genius Act under under acceptable reserves, 100% reserves. So every token has to be backed 100% by these reserves. And these reserves are basically government securities, bank deposits. There's other so-called high quality assets and that are highly liquid, so that there's zero credit risk, supposedly zero credit risk with these stable coins. There's still market risk, because if you're holding government securities as 100% security for the token and interest rates go up, the value of the reserves declines and you're exposed and you have to buy more. So it's not riskless, but it is far safer, and there's no credit risk associated with it, so long as it is in these high quality liquid assets like government securities, short-term securities, deposits. Over time, I will promise you that the industry, the stablecoin industry, will ask for permission to have other types of assets back the stablecoin, less liquid, maybe AAA, but credit rather than government securities. And that's when you begin to see the creeping into a higher risk instrument called a stablecoin.
The anticipated demand for treasuries, one of the reasons why the 10-year has been falling all year. I don't know if that's related, but I'm just speculating here. Scott Bessent has said, following the enactment of the Genius Act, that he expects this to bolster demand for U.S. treasuries and put the dollar back on the map as a global reserve currency. So what's the relationship there?
Well, I doubt that it's going to have that kind of effect. I think, first of all, why is the 10-year coming down? Because the market expects and will not be disappointed that the Fed's easing rates. That's why that's coming. And they expect another cut yet this year, and they're going to lobby hard for it and into next year. So they're talking about another at least 125, 150 basis points cut. That's why that's going down. Whether that's a correct interpretation on the part of the market, I question, but that's what the market's thinking. As far as demand for government securities, the idea that you would be able to solve the debt problem by stablecoins, I think, is a fallacy. The government always puts its debt somewhere, and there's a price. You may be talking basis points, but only small basis point differences. It will depend on how much the banks buy of this debt and how much the Fed monetizes it. And one of the discussion items that's getting played in the paper right now is whether at this meeting that the FOMC is going to have tomorrow, in tomorrow, is whether they will change their balance sheet management, whether they will stop quantitative tightening and perhaps re-engage in quantitative easing, or at least the purchase of government securities. That's what also will cause the 10-year to come down.
I want to go back to stablecoins for a minute now, Thomas. There's going to be more adoption for stablecoins, even at the consumer retail level. And one of the concerns is how protected these consumers are going to be. Now, there are some platforms out there that promise a yield on stablecoins, and this BIS paper addresses this concern, dated the 23rd of October, so this week. Some crypto asset service providers offer yield-bearing products based on payment stablecoins, even though these stablecoins are not inherently designed to generate on-chain returns to holders. So just think of a stablecoin as something tethered to a fiat currency. But now, instead of going through a bank, you can just own stablecoins on your wallet. That doesn't inherently generate a yield. And so there are these providers that now do whatever it is that they need to do to provide a yield on, to the user in their crypto wallets. It says here, these practices may blur the lines between payment instruments and investment products. They may compete with bank deposits, but are often provided without equivalent prudential oversight. This is a brand new sector. Thomas, how should regulators, including organizations like the FDIC, approach this issue?
Well, if I understand the Genius Act right, the FDIC, the OCC, and maybe the Fed have some prudential supervision over these stablecoin issuers. Now, it's not the same as the banks, that's for sure. And I would tell you that these are legitimate concerns, because when they were talking about the Genius Act, it was very clear, at least to some of us, that as soon as it was passed, they would start lobbying for the ability to pay interest. Well, they didn't get it directly, but they get it indirectly. It's like when you had in many years ago, when you had these limits on interest rates for the banks could pay, they started giving other kinds of gifts. If you make a deposit, we'll give you X, Y. Well, that's what's going on here. It's a way to draw dollars in, and they're going to try and deploy those dollars to maximize yield, and they're going to try and allow themselves to hold to pay interest, and then soon after that, they're going to ask if they can have as their reserve amount, their reserve for these stablecoins, less liquid, higher credit quality risk assets. And that's when the trouble starts. That's when the risk increases, the leverage increases, and then you have a moment where people lose confidence, either because interest rates have risen or because one of these stablecoin buyers can't make a payment, and then you have a run, and they'll turn to the Fed for bailouts. And in fact, Governor Waller at the last week was talking about having these stablecoins have an account with the Fed. So now the Fed's a counterparty. So you can see where this is leading. It's another form of currency, but it basically will disintermediate some of the banks, change the nature of it, but still have risk and still be a source of problems.
So I know from talking to some of these crypto service providers firsthand that one of the ways, like they have different instruments and different ways they could generate yield, but one of the things that they do is simply lend out their reserves and then pay deposits through the spread, similar to how a bank actually operates. So essentially they're operating like a traditional bank, except they're not a bank, like you said. So what are some of the risks that consumers need to be aware of, and what should consumers do to find out more about the risk that they're taking with these instruments?
Well, number one, if I understand correctly, the Genius Act says it cannot rehypothecate the reserves. They can't lend them out. So there should be some restrictions there, number one. Number two, though, the only value of a stable coin, not the only, the purpose of a stable coin is to facilitate payments, instant payments, especially across borders. So if I'm a consumer, now we're talking about stable coins backed by high quality dollar assets. If I'm a consumer, unless I have some kind of a payment need that's different than what I normally use, I don't see why you would invest in it. Only time will tell. If I have let's say I have a son or daughter overseas and I want to move money to them, okay, I can do it using stablecoin. Okay, that's a special purpose need. All right, fine. But if I need to make a payment to someone in the United States, I can use Zelle, I can use instant payments, the FedNow, the bank's instant payment programs to get that money there. So there's no real unique need for a stable coin outside of international transactions. And even then, it's a matter of timing and cost.
The crypto community is pushing a lot of its users to use wallets. So that's personal self-custody versus going to a bank, whether you're buying Bitcoin or a stable coin for whatever purpose that you as a consumer need. Let's assume this trend continues and we have a lot of users, instead of putting their fiat money in a bank, they put their fiat money in a cold wallet via a stable coin. Now, I know through conversations with yourself previously, you told me that you're against the FDIC backstopping crypto asset companies. Are you still of that view, even if there's a wider adoption of people directly self-custodying on wallets?
Well, it's a matter of choice, isn't it? Those same individuals put their money in a bank that's insured, or they can put it in a wallet. And the wallet, at the moment, pays no interest. Is there just for payments purposes. You can do that elsewhere. If for some reason you want it in that wallet and you want it for because you think stable coin's cool, well, fine. But that's not, I don't think that the government should be guaranteeing that so you can have an instant payment domestically when you have one already in the banking system. So, and the problem is you're broadening the safety net, therefore you're broadening the moral hazard issues that you have to deal with later. And when these companies, think about it, with a money market, a stable coin is a money market with a payment franchise. in the great financial crisis, money markets, supposedly backed by high quality liquid assets, got into trouble and broke the buck. And guess what? The taxpayer and the central bank bailed out the money markets. It's not free. It's not free. And so I want to make sure that what they're doing serves a purpose that the banks can't serve at this stage, at least.
Okay, now let me just draw on a practical example from earlier this year. I don't believe you and I have talked about it. So Bybit, as you know, got hacked earlier in February. This was the largest crypto hack in history. A group of North Korean hackers stole $1.5 billion in Ethereum tokens. Now, most of those funds were returned to investors, and Bybit was able to replenish its reserves. If this were to happen, now this isn't the exchange being malicious or irresponsible with their funds. This was a hack. What if anything should the government do about this kind of incident?
Well, what they did do, they basically tried to find the source and to get the money returned. Should they insure it to where there's no accountability on the part of the depositor? Heck no. I mean, you have to know where it is you're putting your money and trust it or not. I don't see why the taxpayer, the government behind it, the taxpayer behind the government should say, yeah, put your money wherever you want. We'll take care of it if anything goes wrong. That's not the purpose of the government's role with these stablecoins and these bitcoins.
So just to sum up our discussion so far, do you believe currently there is a slowdown in the economy to such an extent that the banking industry is at risk from either a housing bubble, which was the case in 2007, 2008, or a series of bad loans, or all of the above other things?
No, I don't think so. I think the economy is extended. I think it's re-leveraging. It's not well into the process yet, but it is increasing its risk profile. And if that goes on indefinitely into next year and beyond, then the risk will rise and the banking industry will become more exposed. And that's what the supervisors need to be aware of, and what the Fed needs to think about as they lower interest rates and encourage this kind of activity, this speeding up of the economy when it's already at a fairly rapid pace.
Despite some headwinds to the economy, there seems to be a pickup in M&A activity in the tech space. Just today, for example, NVIDIA announced a $1 billion stake in Nokia. This follows an announcement earlier that Microsoft is investing additional money into OpenAI. And there seems to be a lot of cross kind of financing amongst big tech companies. Can you just provide an overview of the M&A landscape right now and why there seems to be so much activity?
Well, I think it's because AI is a very hot topic. It's like the dot-com bubble was in the late 90s. It's the thing to put your money in. It's on a wave up. So you have a lot of this going on, and you have these companies buying into one another. That increases the price of their stock. It's all kind of it's all part of a speculative trend that we're seeing that I think will build over time. So long as the price is going up and people think I got to get on this wave, you're going to see this continue. And I would expect it to continue until, and the famous phrase, it will continue until it stops, and then it'll be a really kind of a nasty exit.
What usually prompts these kinds of things to stop?
People begin to figure out that for all the money being put in, the yield on the investment isn't anything like you expected. Your yield so far is coming from the fact that the value of the price of the stock is rising rapidly, rather than the earnings flow coming into the institution is rising rapidly. And so that's what you have to watch. Where is this going? Microsoft puts X hundreds of millions or billions, whatever company it is. Are they getting a return or are they not? And if they are not, and that goes on for an extended period, they're going to say, wait a minute, what am I doing in this stuff? And Microsoft will back out. And so you'll see this thing kind of turn in on itself, and that's what you have to watch for. Now, if AI is the thing everyone thinks it is, and it really does begin to provide a return to the investor, then we may ride this for quite some time. That's the decision the investor's trying to figure out right now. Is this permanent, or am I riding a wave? How should I look at it? And if they're riding a wave and they get out too late, they'll lose money.
The final question, Tom. Should the Fed be concerned with capital markets? There's a theory out there that the wealthy, their wealth is dependent on the valuations of assets in the stock market and other assets. And so if we have a stock market correction, we could potentially see a lot less spending in the economy. Now, that's just one theory, but overall, should the Fed make it an unofficial policy to be following capital markets?
Well, I don't think they obviously are going to follow capital markets. I mean, that's part of their job. Whether they follow that to the exclusion of others, that would be a terrible mistake. But, the capital markets are something that you should watch. For example, while incomes have gone up modestly, while real GDP has gone up 1.5 times in the last 20 years, the stock market has gone up 5 times as high. So that there's an enormous amount of wealth that has been accumulated in the stock market and in the capital markets. So that's why they're looking at it. That's why it's so important. So if you had a major correction in that, it would probably almost certainly slow consumption, slow investment, and therefore turn the economy to a much slower rate of growth, or even a recession.
Thank you very much, Tom. I appreciate your insights. Where can we go to follow you?
Go to Mercatus.org.
Okay, we'll follow you at the Mercatus Center. Thank you very much, Tom, and I appreciate your insights. We'll speak again next time.
Absolutely. Look forward to it, David. Good to talk to you. Bye-bye.
Thank you for watching. Don't forget to like and subscribe.